There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone, I'm going to talk about option puts and how you can use them for mitigating your downside risk or hedging during a downtrend. Option puts have been used by the professional side, the buy-side institutions, pro traders, proprietary desk traders, and floor traders for quite some time. After the banking debacle of 2008-2009, the buy-side institutions decided that they were no longer going to be buying hedge funds and other things from the sell-side institutions because they didn't trust them anymore. Because not only did the banks lose a ton of money on the mortgage-backed security credit default swaps, those who bought the credit default swaps found that the banks could not meet their obligation, and they lost a lot of money as well, and they were surprised at how much risk was included in the mortgage-backed security that the credit default swap was supposed to insure. So instead of insuring their high-risk trades or investments via a hedge fund or some other type of fund that would offer an insurance policy against downside risk for the mutual fund, they went to two other avenues. One was futures trading, the other was option puts. And this has been in play for quite some time, quite a few years now. The rise of options activity is because a lot of the institutions are now using option puts instead of hedge funds or other alternative funds created by the sell-side institution. For one thing, it's a whole lot cheaper for them. And two, their floor traders and proprietary desk traders are fully capable of option trading. But how can you benefit from option puts? We know that when there's a huge surge of option puts, and a very large lot order going through for a stock, say all of a sudden we see that there's 3 million shares being bought, a lot of options market makers can actually compare this. They can see the activity that is there for the option contract to cover a very large lot purchase that would be a short-term trade. But they also can mitigate their downside risk with it on longer holds. Today, the question was, how can an option put be used for investors who want to hold through a short-term or intermediate-term correction? If we have a full-blown bear market, if we have a major catalyst that sends a ripple of panic and fear through the market that can sustain and actually cause a major collapse of the market, you'll want to consider your alternatives to holding for a 1.5 to 2.5 year bear cycle. The stock market itself may not go down more than 50 or 60%, but a lot of stocks will lose as much as 80%. And that is very hard to recover from. Microsoft collapsed, Intel collapsed, Cisco collapsed. In the prior bear market, that was a stock market bear. The bear of 2007 to 2009 was actually a real estate cycle bear. Microsoft, Intel, and Cisco languished in a sideways trading range for 13 years before they finally broke out. That would mean if you had lost money on that, you would be sitting on that stock for 13 years making no money on it whatsoever. So it's not just the bear market, it's what happens after the bear market to that stock. So if we're in a bear market, you really have to consider how you can really protect the gains that you've made and where you're going to get out. Because if you're controlling your own portfolio or managing your own retirement account, you can do better than the mutual funds because they are restricted by requirements, regulations, compliances, and so on and so forth. So the average investor, if they know what they're doing, can do better if they're fully trained. And if they follow their investment parameters, follow the rules, and understand what they should and should not do, and don't take high risk. Option puts allow you to mitigate or lessen the downside action of your long-term held stocks. If you have a stock that you have been holding for a long time, and it's a long-term investment, and we're in a short-term correction, and you want to mitigate that downside because it's starting to move down, you can buy option puts. The option puts would be purchased with the intent of selling them before they expire. That would be how you would make the profit to offset the losses of your stock. Now, it takes some calculations. It takes some understanding of what you're going to do. You really need to take a full-blown options course. We have one that is completely different than what everybody else does because this is the approach we're taking. A lot of times we want to teach people how to manage a long-term investment portfolio without having to sell it during an intermediate or short-term correction. Or sometimes you just can't sell it and you would have to endure a bear. You would still want to mitigate or lessen the losses. You cannot do it dollar for dollar. So here's how it goes. First, you have to study the stock chart. You have to determine where that stock is going to find moderate to strong support. Moderate to strong support is always going to be found because it's going to be dark pool, quiet accumulation zone. That's where they will start buying again. They will allow the stock to fall and fall and fall and fall and fall. Their job is not to time the market and get in and out of the stock at the top. Their job is to buy at a price which they deem is equal to the value of the fundamentals of the company. So the mutual funds are not intending to sell at a top and they're not intending to buy at a bottom. In fact, the institutions often are the catalyst for developing a top with their slow rotation because they're lowering their inventories. And they buy at a bargain price. They wait for that stock to go down to a certain price before they start their accumulation. Now, whenever the dark pools are consistently, and they usually do it in a group, they usually all recognize the fundamental patterns and the quantitative analysis that they're all doing. They're all very similar algorithms that they're using. They all have a tendency to buy and sell at the same time. Accumulate, rotate is what it is. Rotation is the slow lowering of inventory. Accumulation is the slow accumulation of inventory. They have to do it over time because they're buying millions and millions of shares of stock, and they can't buy them all at once unless they're in a big hurry. And a lot of times, if they buy a big chunk, they'll be buying it directly from a sell-side bank or directly from a dealer, not going through even their dark pool venues, or they might buy it directly from the company itself. A lot of corporations have bought a lot of buybacks, shares of stock over the last several years. So a lot of corporations are sitting on a lot of their shares of stock, which are no longer outstanding because the company owns them. That has lowered the inventory of available outstanding shares for nearly every big blue chip stock. So the buy-side institution might go to the corporation and buy it directly and buy a large chunk, a block order, all at once. But most of the time they do incremental buying, which is done on an automated system using a special type of order that buys them in if the price hits this price, but doesn't continue to buy if the price exceeds a certain price. So buy me in at this price, but if the stock climbs further than this price, stop the automated accumulation mode for that stock. But what that causes is an up and down action that goes sideways. This occurs when they're rotating. This occurs when they're accumulating. And you can see it on the chart. And I call it the dark pool buy zone. That's my term. If you hear it someplace else, they've stolen my trademark. The dark pool buy zones are what I call them. The buy zones are fairly narrow, not a consolidation size, but not a wide sideways pattern or a trading range. They're a tighter formation that goes sideways, and they're very consistent. And you can see that the high of that sideways action stops at a certain point, and the low of that sideways action stops at a certain point, and that's the buy zone. Sometimes HFTs will get in there and cause stock to move down a little bit or up a little bit, but it really quickly resumes that sideways action, and that is a dark pool buy zone. So you identify those on the chart because that's where the buy zone is, and it will resume when the stock collapses to that level. Because during speculative markets, the dark pools are not buying at a higher and higher and higher speculative price like retail traders or smaller funds. They're far too savvy and far too wise to do that. They would not do that. So all those angles of descent that are very steep, that are 90 degrees or 80 degrees, that is all speculative traders. Mostly retail and smaller funds buying or HFTs buying and causing the stock to rise speculatively. The HFTs may decide to rotate at a certain point or they may just continue to hold. So in a short-term to intermediate-term correction, your stock is moving down. You want to mitigate the risk by using an option put. To do this, you must first know how many shares of stock you have. If you have 500 shares of stock, an option put does not rise in value dollar for dollar or point for point per the stock. It's about 0.50 or 50%. That's your delta. And that's pretty typical. Sometimes it's different, but never trade the anomalies of options. That's for the pros. Unless you're a highly skilled, highly seasoned, have had 10 or 20 years of hugely successful option trading, don't trade the exceptions. So we know that the basis of the option put versus the stock to mitigate the downside would be that you would need 2 times the number of contracts that you have for the stock. So each contract is 100 shares normally. There are many option contracts, but let's just stick with standards. If you have 500 shares, you would need to buy 10 contracts or 10 times 100, which would be 1,000 shares in the options put. That way you have nearly identical value for value that it's going to move. If the stock moves down a point, the option will move down about half that amount. This is just a range. It's not a precision thing because they all move differently. So that's how you first calculate that. You would need to be able to do that. You would need to be able to match your stocks 2 times the contract. That gives you enough that you can almost mitigate it, but you will never absolutely get rid of the downside loss completely unless you did more than that and you were really savvy at your option puts. Then you have to calculate how long it's going to take for that stock to fall to a buy zone or a pro trader's buy to cover zone. And you need to see that in the stock charts. And that's very specific candlestick technical patterns. They're very identifiable. That's what I teach, and nobody else teaches it. And that gives you how long it's going to take to fall, because you can take the angle of ascent and angle of descent and calculate just how long it's going to take that stock to fall. If it falls faster and you're in an option put, that's not a problem, because option puts have a time decay and you have to worry about time. You have to buy the right option contract time-wise, as whether you buy 1 month option contract, a 3 month option contract, or if you're going to carry it longer than that. So you have to calculate how long it's going to take for that stock to fall to that buy zone or that pro trader buy to cover zone. And then you would want to sell those puts before it hit that support level, either one of them, depending on how you're doing it. There's short term, there's intermediate term, and there's other things involved. I'm just trying to give you some framework to understand what's going on. All this has to be calculated, and it has to be calculated very carefully. What we have with our options course is a long options calculator and a put options calculator that does all this work for you. So you plug the numbers in and it comes up with all the things that you need to know. It will tell you the option contract you should buy, the time duration of that contract, and when you should sell. This helps you a lot. Now, it can be varied from that, but it gives you these parameters in which to work instead of just guessing. So you have a very good idea because you're using technical patterns, which tell you what the dark pools and the pro traders and everybody else is doing, and then you plug them in to get the calculations that you need. This will help mitigate, but not eliminate, the downside risk. And this can be a huge benefit for people who can't get out of a mutual fund or an index fund or a pension fund, and the stock market is going down. You can buy option puts against that fund, and you can dramatically avoid huge losses. But you have to know what you're doing. You also have to use a specific option put. You don't want to buy the cheapest option put you can find, which is way out of the money. You have to carefully calculate, and usually it will be the at the money. You pay a little bit more. Now, you also have to factor in that you're going to be paying for the option contract. That's an expense. You're going to be paying your broker, and that's an expense. And so you may have to buy a few more contracts in order to cover those expenses as well. As I said, it's not a perfect point-for-point replacement. So if your stock goes down a point and you have 2 or 3 option contracts to match that, you should be fairly within the frame of getting close to eliminating a lot of the loss. but not every penny of it. That's the reality of working with option puts in a downtrend. But you can save yourself a huge amount of loss, and you might even make a little bit of money. I know a lot of people who use these on other strategies during bear markets, and they do very well in mitigating the risk and lowering any kind of loss that would be significant, because the stock will come back up. Usually, if it's a good solid company, it will return and come back up at some point. That's why you have to really calculate where that strong support level is, that the dark pools are going to start buying it, because you have to sell that put before you get there. And that's very important. I have this all laid out in our options course, which is totally different. And if you already trade options and you're all in love with all these strategies that have all kinds of complicated options, straddles, strangles, the condors, the butterflies, and all of that, then you're not going to like how I teach options. Because my options training is straightforward, it's simple, easy, anybody can figure out how to do it, and they can get going on it very rapidly. When you start trading the exotics, I have to warn you that you are now trading with the market makers, and there is no savvier short-term trader than the market makers. They know what they're doing, because they have to often get into a losing position, and then they have to buy different variables of option contracts. That's why the exotics were created. They were created for the options market maker. I have a market maker friend, and she says, I don't understand why the retail traders use these, because they're not for them. The problem is that in the options world, as in a lot of the different worlds of financial market, if you offer a product to one market participant, you have to offer it to all of them. And your brokers make a ton of money by convincing you, by promoting heavily, that you should be using these very exotic, complicated option contracts. If you get one leg wrong, you're going to lose a lot of money. And it's complicated and it's expensive. And so people who use them, sometimes they make money, but most of the time, in the reality, when I really set them down, I say, are you really making money with these? They have to admit that they're not. They're just gambling. When you do an option put to mitigate the risk of your downside action on your stocks, you're going to be using a simple option put. Simple. This is from market makers. This is from professional option traders that I've talked with and we've discussed things with and gone over. And they say that is the best way to make the money and make it work. To profit from an option put to the point where you can mitigate or get rid of most of the loss that you would have on that stock. So don't complicate things when you try to do this. But also, I advise you that you're not ready to do this until you have a thorough understanding of the entire process. I've laid the rough framework for you, but there are a lot of variables and a lot of things that you have to learn. You have to learn the relationship between the stock chart and the option contract and how that's going to work. You also need to be able to properly calculate all of these things, the time, the price of it, how many you should be buying, so on and so forth, so that you have the right amount to make this option put strategy work. So you need more information than just this radio talk show. No one teaches this actual process. They're trying to get you to use complicated things, straddles, collars, strangles, and so on and so forth, because the industry makes a huge amount of money from retail trader options traders who are using these more complex strategies because they believe they can lower their risk. If you know what you're doing and you look at the stock chart and you see what's going on, the option will follow the stock almost every time. It is so in tandem because we are an automated market now. So a lot of the complex Black-Scholes models actually have been proven by the professional side. They did a study and it's actually proven that that doesn't work. It doesn't even work. Nobody on the professional side is using it anymore. They have these new indicators that they're using, and they're not even using the ones that are available to you. So the professional side options trading is completely different. And what I've done with the options course is I've simplified everything because I have a lot of people who do not have that much experience and they need to have something that is sensible, reasonable, easy to use, and straightforward and not complicated so that they can do this process and succeed in mitigating or lowering their losses on their held stocks during a short-term to intermediate-term correction. If this sounds like something that will work for you, then come visit us and take a look at the options course outline. We have an outline for every course, and the options course outline is on our website. You can take a look at it. If you're an old veteran options trader and you just think that what you have is working, great. If your options trading is at the 80 to 90% success rate and you're making very, very high profits with minimal losses, only 10% or 20% of the time you take losses and they're very small, and 80 to 90% of the time you're making huge profits on your options, you don't need me. You're good. You don't need any more. You're fine. But if you're just starting to look into options and you haven't done anything with them before, you're concerned about the bear market. So if you're interested in that and you want more, then come to our website, check out the options course. If it looks like something that makes sense to you, then give us a call and we can talk about it. My goal is to help people who I can really help. I'm not churning out tons of little traders. I really want to work with people who are deeply concerned about doing things properly, who want to work as professionals work, and who have a sensible attitude. It's going to take some practice. It's going to take some time. You have to understand, and you have to take a full course to really understand what you're doing. You can't just take and watch a couple of webinars and go out there and think you're going to be successful, because you're not going to be. And nobody's going to tell you that. They're going to tell you, oh, it's great. This is going to work. Here you go. It's not. And I'm just telling you, and a lot of you won't like to hear that. And that's okay. Options puts is a wonderful way that people who are in a long-term position who either do not want to sell their stock or cannot sell their fund or index fund or pension plan, but they want to mitigate their downside risk and losses. But you have to know what you're doing. I gave you the framework today. I gave you an idea of how it works, but you need more training than that. So if you decide that this sounds like something that's interesting to you, come visit our website. I'm Martha Stokes, and that's the radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.